Good afternoon, this is Blake Young with the TheoTrade evening video for February 6, 2023, and today we're talking about the dollar dominance precedes the weaker market. Today was a fairly quiet day. We really didn't have any major economic announcements. We didn't have any significant earnings reports. It was all about the continuation of the US dollar strengthening off its annual lows. As you can see here, the dollar index has bounced and bounced aggressively 3 candles in a row. These are very sizable candles, erasing about 4 weeks of weakness, the breakout from what we saw for all of December. So this sell-off that we saw in the US dollar appears to be over and returning back to the balance area. This 50% level is our annual fair price, predicting the 2023 fair price value all the way up at 105. And if you're a technician, you probably would recognize this as 3 white soldiers, and conversely, the Euro US dollars has created 3 black crows. The 3 black crows we have through here usually indicate a continuation pattern for the bearish for the euro and bullish for the US dollar. And even though we might get a little bit of a correction, even though we might get a little bit of pullback, this is still clearly, from my perspective, a strong bounce for the US dollar. It's just whether they can clear out this area right through here and continue pushing the US dollar higher. The fact that we had record-breaking employment data going back 50 plus years is going to continue to support the idea that the US dollar has the flexibility, or the Federal Open Market Committee has the flexibility of continuing to raise rates. Today we will see the Australian, or the Reserve Bank of Australia, raise rates probably to 3.35%. That's another quarter point for Australia, but that doesn't even push it into the top 2. Australia raising rates will push it up to the edge of where the pound is, but it's still not pushing past the US dollar, Canadian dollar, New Zealand dollar, and pound for high interest rates. Which means from a comparative standpoint, the US dollar could be the dominant currency again going through this first quarter. Again, whether we can clear out this area. Here's the thing that we want to look at. The dollar and its correlation to US equities. If the dollar is getting stronger, does this precede weakness in US equities? Does the stronger dollar and its higher purchasing power tell us that we are going into a deflationary or disinflationary market? Let's throw on a correlation study up here, going to studies, edit studies, and put in correlation. Correlation study is similar to what you would find in essence, any spreadsheet or any math calculation. It's the same calculation. And what we're looking at is saying, what is the correlation or calculation percentage-wise of the dollar index to the SPX? And we can do the same thing with futures and look at the future S&P futures as well as the dollar futures. But let's start right through here. What we want to do is we want to look at 1 and -1. So we'll zoom into the 1 and -1. A correlation study can't go past 1 or -1. A perfect 1 says they're the exact same instrument, positively correlated. And -1 would be a perfectly inversely correlated, meaning that it is constantly moving the exact opposite of the underlying. So what are we seeing here? Over the last year, if I were to highlight the negative or inverse correlation and highlight that with the SPX, and we go from 0 down to -1, and we're to look at the last year, what is the correlation? As we look, the dollar index has an inverse correlation to US equities, at least over the last 6 months, where we only have 6 days that we have not had a negative or inverse correlation. If I look back over the year, you can see that is fairly consistent, that we're continuing to see that inverse correlation. The question is, if this is the inverse correlation, and I can go back even further, we can go back 3 years and say, this is pretty consistent. We can go 5 years, we can go 10 years. The US dollar, when it's getting stronger, means equities go down. When the dollar gets weaker, equities go up. And we can see the correlation even on the weekly chart at a 54% inverse correlation, reaching as high as a 96% inverse correlation, which would indicate that for every dollar point, every point the dollar moved up, then equities should move down. Every point time the dollar goes down, equities should move up. And this is math, right? This is not a speculation at all. We can go back and look at numerous days in history. But right now, over the week to week, we're at an inverse 54%, which means we can expect an inverse about half the distance opposite direction of equities versus the US dollar. But that's not all that it's telling us. If we go into the daily chart, going back into the current price, you can see we actually crossed over to the positive correlation. This is a disconnect And you could think of this as a divergence of cross-market correlations. In history, when we see those disconnects, we can see that the dollar traded flat continually through here. But that breakout, if we look at the date, that's on December 29th. And if we go back here and look at the breakout through here, and we go back to, let's call that August 18th, August 17th, 18th, 20th, what were the U.S. equity indexes doing during that time frame? To match up those time frames, we're talking about right here, there's your 17th and 18th, right before equities sold off. If we go down to December 29th, December 30th, when we saw that consolidation, again, is maybe 2 days before the big breakout. This consolidation and disconnect precedes significant moves. The fact that we rejected an area that had a lot of sellers from back in August last year, the fact that we've had gap downs close down on the SPX, the fact that we are seeing the dollar rally 3 days aggressively, and the fact that our historic correlation has been 2.5 times the move in the dollar bearish in U.S. equities, it appears that this bullish move without seeing a bigger drop in equities is setting up for the next leg down in equities. And again, I'm not trying to speculate as far as assuming that the market is going to go bearish. I'm saying that the dollar's correlation, historic correlation, sees about a 2.5 times move in equities for what the US dollar has done. So from this low, we might be able to line this up, and this is what we talked about this morning a little bit too, but we might be able to say, look, we've already moved 2.7%. If we get back up to fair price, the yearly fair price, we are looking to about 4%. Therefore, if the US dollar is going to continue to climb and hit this fair price, and we get back to the same correlation, the same movement as we've seen in the past, which means the dollar climbs and equities sell off with the 70, 80, 90, 95, 96% inverse correlation, then the move down in equities could be 4% times 2.5%, which is setting up for a 10% drop. And even from where we're at, where this correlation has decoupled, if we're saying that's close to 3%, we should be or could be seeing a 7.5% drop in equities. Going back to the SPX from the high, if we were to mark that up, and so we're not trying to make it even bigger than what it was before, but even from the high, already adjusting for the move we had, we have only dropped 2%. A 7.5% move, where it could be if the correlations were the same as they were earlier this year and multiple times, in fact the majority of the time, about 95% of the time, that inverse correlation should be seen and pushing us down to 3,900. That's just to make up for what the dollar has gained over the last 3 days. If we see the full move up to fair price for the dollar, then U.S. equities could move the full 10%, and a 10% move would push us right back almost perfectly to the lows back last December. That sets us up for the move not to the lowest of lows, just to the lows back in December. That is an easy target. It is a target that would not need record lows. It's a retest of one of the strongest consolidations and correlates again to the same consolidation that the US dollar has already worked with. What is interesting to me is that the SPX has an inverse correlation to the dollar, and gold has an inverse correlation to the dollar, which means the SPX and gold usually have a positive correlation. If we're to look at GLD, since we're looking at the sectors, not the futures, let's go to GLD and look at the positive correlation with U.S. equities. Again, we need to alter this just a little bit because we want to zoom into 1 and -1. We don't want to have it auto adjust that. We want to be able to see the full range of correlation versus non-correlation. So if we go from 1 to -1 and look at the last year, in this case last 6 months, we'll zoom out to the year in a second, and look at from the 0% to the 100%. This is the positive correlation from the U.S. equity to gold. They usually work in lockstep. There's occasionally times that they disconnect a little bit more frequently than the US dollar, but they have a positive correlation. So gold generally moves in line with the SPX. And we can look back even further. There's your 1 year. And there's your 3 year. So very high correlation, not as strong as the inverse correlation with the US dollar, but extremely solid. And you'll see the 59% on the weekly is matching what we're expecting from gold positively with SPX and inversely correlated with SPX and the US dollar, and in this case, US dollar and gold. Going back to the current time frame, we're seeing that same decouple. We've disconnected again. And so watching this move back into this area, that it does not mean that gold's going to bounce. It probably means that SPX is going to chase gold. What percentage has gold moved from the high? We go from the high, roughly, if I can get my cursor there, to the pullback, and it's moved approximately 4%. Better than what we've already seen in the other. What does 7.5% look like? 7.5% for gold takes us right back to the consolidation again. The correlations are there. We've just disconnected. So the SPX appears to have been overly resilient, and it's the SPX that's out of line. When we see the dollar agrees, gold agrees, and the other markets are showing that these moves are there and in place, then it's the game of the old Sesame Street. One of these things is not like the other. Come on, can you tell me which one? Right now, it's the SPX. And so all the correlations are pointing to the fact that the SPX is out of line, and therefore we should be seeing and should expect to see the SPX to snap back in line with gold into a positive correlation, which means the SPX down, or inverse correlation to the dollar, which means the SPX down. Both of those are pointing that direction. But just wait for a little bit of a pause. Generally speaking, one more time back to the dollar index, generally speaking, 3 solid days usually sees a pause. Sometimes it's a flat move, sometimes it's a pullback, but we're generally looking for a continuation, whether it's like a short flag, a bull flag type of situation. But I am looking for the dollar to get up to these levels. So after a pause, maybe today or tomorrow, maybe in response to the Reserve Bank of Australia, maybe as we hear Powell talk tomorrow on Tuesday, watch for the volatility, watch for a little bit of pullback. But if we continue past today's high, we should be looking for 104.86. And I believe that Powell is probably going to be more hawkish in his comments tomorrow as he continues to make the case for not just a rate hike in February, which you already saw, but March, possibly an additional one before we get to June, so that we can get to 5, 5.5, 5.25, where we're pushing to fight and stop the inflation rates as they've already been talking about. With Australia raising rates tonight, with the Bank of England and the ECB, European Central Bank, raising rates last week, 50 basis points, it still gives the U.S. room, especially with the fact that we have the best employment market in 50 plus years. That's what I'm expecting. A little bit more volatility after as the Fed speaks, maybe a little pullback over the next day or two, but if the dollar is going to continue to advance, watch for the potential weakness in the SPX, pushing down anywhere from 3 to 5, even as far as 10% from the peak over the next month. Thanks for watching. We'll talk again later on.